Welcome to the NAIFA Webinar series, providing you with timely information and training each month on topics of interest. This is Brendan Burnett, Director, Professional Development and Education Programs. This month, we are presenting Using Home Equity and Retirement. With me today is Colleen Rideout. Colleen has been in the real estate and mortgage banking industry for over 30 years. She began her reverse mortgage career at Wells Fargo Home Mortgage and is currently with Security One Lending, the largest reverse mortgage lender in the U.S. For the past year, Colleen has been working in conjunction with NAIFA, teaching about reverse mortgages in long-term care classes. Colleen has also been teaching her continuing education course, Using Reverse Mortgage in Retirement, throughout Colorado. Her mission is to educate insurance and financial professionals, as well as consumers, about reverse mortgages as part of retirement income planning. In today's webinar, designed specifically for NAIFA members, Colleen will introduce the use of the reverse mortgage as a tool to protect the client from realizing their greatest fear, outliving their money. She will dispel myths and deliver case examples of how to use the recently remodeled FHA home equity conversion mortgage so that you will be confident of when and how to discuss the reverse mortgage with your clients. During the presentation and question and answer session, you may type questions in the question box on the right side of your screen. Questions will be answered during the question and answer session at the end of the program. So let's begin. Colleen, I'll turn the discussion to you.
Good afternoon, everybody, and thank you so much for joining. I want to give a little bit of introduction here. You see my picture on the left. I'm a home equity retirement specialist with Security One Lending. And on the right-hand side, you'll see my partner, Steve Thomas, who is the Chief of Operations of NAIFA Colorado. Steve and I met about a year ago, and I think Steve's probably on the line today. We met about a year ago. Steve had been teaching the long-term care classes in Colorado for about 8 years and teaching the home equity portion on his own. So about a year ago, he reached out to me and said, let's see if we can't do a better job of delivering the information about a reverse mortgage. This is the presentation we'll be using going forward in all of our long-term care classes. So I will introduce it the same way Steve would do. If what you thought to be true about reverse mortgages turned out not to be true, when would you like me to tell you? Thank you, Steve. And my screens aren't advancing. There we go. Rules of the road. Let's first start with a disclaimer. These strategies are not designed for the purchase of investments. They are designed to maximize and protect existing investments. And this is very important. This is what you're doing already. You are helping your clients use their retirement money slowly, conservatively, and deliberately so as to last throughout their lifespan. So this is going to be nothing new to you folks on the webinar today. And what's very important to all of you is what FINRA has to say. So FINRA historically has taken the position that a reverse mortgage is only a product of last resort. In October, so FHA made the changes to this home equity conversion mortgage product, HECM, made big changes to the program on the 1st of October in 2013. FINRA came out with this statement the end of October in reaction to the changes FHA made. And you can look this up, the reference is below. FINRA is issuing this alert to homeowners thinking about reverse mortgages to make informed decisions and carefully weigh all of their options before proceeding. It is to be used prudently. And that's what you're doing already with your clients' money. Hopefully we're going to show you another way to do that. So let's talk about the agenda. The first part of the program is going to be explaining to you how a reverse mortgage works. And I'm going to explain it to you exactly the way I do every single one of my customers, because my biggest challenge is not to sell mortgages, but to teach people how reverse mortgages work. They're very different than what you're used to. The middle part of the presentation is going to be about consumer safeguards and how we can use this product in the distribution options that are available. And the last section is going to be 4 case studies. And hopefully one of these case studies is going to hit home with each of you, because you're going to see different customers in each one of these scenarios. The line at the very bottom is the most important. That's the reason we're here. My greatest fear is outliving my money. And that was from my mentor and my dad, Richard Rust. So you're going to hear about Richard. You're going to hear some Richard sayings throughout this program. But this is something that I remember my dad saying from the time I was just a little girl. So let's go forward. In putting this presentation together, I have to tell you that we were looking for stool examples, because, and I never knew until I started looking, how many industries use a stool example as balance for their business. They came from every industry out there. So let's look at the retirement stool. This is retirement income. First of all is Social Security. And I will tell you that through my experience of working with customers, they're surprised about how little Social Security they get. So let's just quickly talk about Social Security. It was always intended to be a base for retirement income, never to replace the customer's working income. In fact, for the average worker, Social Security is meant to replace 41% of their average income over their best 35 years of earnings. So 41% is all that Social Security was ever meant to replace. Here's an interesting statistic from 2013. The average Social Security benefit was $1,264. And some people are shocked to find out how low that is. Interesting for the person who has contributed the most, the high wage earners, the highest benefit paid in 2013 by Social Security was $2,742. So the bottom line is we've got Social Security. Historically, we've used Social Security, qualified retirement plans, and non-qualified savings and investments in order to plan a client's retirement income. So what are we going to do today? We're going to add home equity to that stool, because that helps give it balance, and hopefully you'll see a way to make your clients' money last long enough so that they don't have to realize their greatest fear. Bottom line here is we've got to find all the pots of money that we can in order to help these people succeed in retirement. So what is a reverse mortgage? When I look at this slide, I sort of feel like Fred Thompson. He can deliver this in 30 seconds. We're going to take a little bit longer than 30 seconds for me to tell you what a reverse mortgage is. And he is correct. In 1988, during the Reagan administration, Congress passed a law for FHA to do reverse mortgages for seniors, to help them tap the equity in their home to survive through their retirement years. The proprietary name for that FHA loan is the Home Equity Conversion Mortgage. So when you see the term HECM, you know that you're dealing with an FHA reverse mortgage. And how does FHA insure the mortgages that they do, whether they be traditional forward mortgages, and you'll hear me refer to traditional or forward mortgages throughout this presentation, only so that you can see the difference between a traditional forward and a reverse. So FHA insures these loans by collecting mortgage insurance premium on both types of loans. And they collect that MIP in two different ways. They collect money up front at the closing, and then there is a monthly charge on either mortgage. So on any FHA mortgage, the premiums, the mortgage insurance premiums, are sent to FHA and put into a pool. And from that pool, that's how FHA pays claims. What this allows seniors to do is to convert equity in their home into tax-free cash. And that's a key term here, tax-free. Because this is a loan, these are loan proceeds, and loan proceeds are not taxable. So now you should start thinking, okay, if my client adds a reverse mortgage, I have tax-free money that I can tap rather than having to use all taxable income. The borrowers must be 62 years of age or older. This is the definition for senior in our business is 62 years of age. They need to have about 50% equity. Now, the amount of money that FHA will allow to be lent to any particular borrowers is based upon their age. So the first thing I collect when I'm working with a customer is their date of birth. We use the youngest borrower's date of birth to determine what the loan amount will be. So the older the borrowers are, the higher loan to value they're going to get. So a 62-year-old will get about 50% of the value. Older borrowers, 70, 80-year-old borrowers, are going to get higher loan amounts, up to 60, 65% of the value of the home. It must be their primary residence. Now, they can use this money to purchase, if they did a reverse mortgage on their primary residence, they could use it to purchase a secondary residence, but the loan, the reverse mortgage, must be on the borrower's primary residence. Let's talk about some myths, because when I teach this class to consumers, to professionals, all sorts of people, and the same myth questions always come up. The first is, oh, the only thing I know about reverse mortgages is that you have to give the title to the bank. That's not true. It is exactly the same in this respect as a traditional mortgage. So I have a condominium, and I own my condominium subject to the loan that's on it. I am entitled to that condo subject to the loan balance. It's exactly the same with a reverse mortgage. And who retains the equity? Many seniors believe, when I come to see them, that if they do a reverse mortgage, that not only are they giving the title to the lender, but that the lender will retain all of the equity in the home. That's not true. And we're going to go through that too. They also fear outliving the reverse mortgage. The way that this has been set up since the very beginning, on the deed of trust, which is our contract for the reverse mortgage, the due date is the youngest borrower's 150th birthday. So borrowers don't have to worry about living longer than the loan lasts, so long as they pay the taxes and insurance and take care of the property. They are entitled to the home. The next big one is, are the closing costs the closing costs are very high. Is that true? I hear that all the time. Let's talk about closing costs. I'm going to give you an example. All of the case studies that we're going to look at today are dealing with a $500,000 home. And that value for reverse mortgage purposes is our loan amount. So that's different from the forward side. The value is the loan amount. So in 2007, when I moved over into the reverse business, we were doing reverse mortgages with very high closing costs. Let's take an example of that. On the $500,000 example we're using today, in 2007 we had a 2% loan origination fee, $10,000, a 2% upfront mortgage insurance premium, another $10,000. We had a $5,000 give or take servicing fee. We're now at $25,000, and we are now going to add the actual closing costs, which are about $3,000. So we would do that $500,000 loan for $28,000 in closing costs. Today, you will see through the examples that the closing costs on these loans that we're looking at are about $5,700. So the servicing fee is gone, the loan origination fee is gone, the closing costs remain the same, and the upfront mortgage insurance premium was changed in October of this year. So if a borrower needs to take all of the money available to them, and I will show you a couple of examples of that, purchase mortgage being one of those types of loans. If you have to use all of the money, the upfront mortgage insurance premium is 2.5%. If you don't have to use a full disbursement in year one, that mortgage insurance premium has been reduced to just 0.5% of the loan amount. So I'm going to talk to you now about how a reverse mortgage works. And I think it's much easier for you to understand how a reverse mortgage works if I compare it to something that you know very well, which is a forward mortgage, traditional. And here we're talking about forward again. I want you to pretend like you're Italian. I'm Italian, and I have to use my hands to speak. So I'm looking at my left hand now. And we're going to talk about a forward traditional mortgage on my left hand. So a borrower getting that type of loan gets a loan is given, and the borrower has to make regular payments back on that loan, principal and interest. Because they're making principal and interest payments, that balance is declining. That's called fully amortizing. Also, because they have to make those principal and interest payments, that loan is fully qualifying. In 2005 and 6, it wasn't difficult to qualify for a loan because, you know, we used to say in the mortgage business they just have to pass the mirror test. They have to fog a mirror. We didn't verify income. We didn't verify assets. None of those things. But today, qualifying for a traditional forward mortgage is a very difficult process. Take your other hand, look at your right hand now, and we're going to talk about a reverse mortgage. A reverse mortgage, the borrowers get a loan, but no payments are required. No payments are required. So we say, what happens to that interest that's not being paid? There is no free lunch. Interest has to be paid some way, right? So on a reverse mortgage, the interest accrues to the loan balance. So remember, we're starting with a loan balance of about 50%, so that interest that's accruing every month adds on to that loan balance. So on a forward mortgage that is fully amortizing, a reverse mortgage is negatively amortizing. It's the only loan left in the system today that has a negatively amortizing feature. Also, because the borrowers on a reverse mortgage don't have to make payments, we don't have to qualify them. So today, we can have a borrower that is in foreclosure with that property, that has just completed a bankruptcy. It doesn't matter. We're not going to look at their income, assets, or credit in order to do a reverse mortgage, so completely non-qualifying. And the kicker is that this is also a non-recourse loan, so that if the loan balance ever exceeds the value of the home, the borrowers nor the borrower's estate are liable for that deficiency. The lender goes to the FHA mortgage insurance premium pool to get that deficiency paid. We're going to talk a little more about that as well. So no monthly payment required, non-qualifying, no income, assets, or credit, except on a purchase. We will verify that the down payment is where the down payment came from. It's a non-recourse loan. And no defined term. The borrowers can live in that house so long as they pay the taxes and insurance. And how are the funds dispersed? The funds are dispersed based upon each individual borrower's circumstances. So these are the scenarios that we're going to go over today. These are what I call the tools in my toolbox, and I'm going to start with the hammer. Our revolving line of credit with a growth factor is my hammer. Let's talk about what that means. What's a growth factor? Because I'll bet a lot of you don't know what that means. FHA says that when you get a reverse mortgage, the unused balance will grow at the same rate as the interest that's accruing and the back-end mortgage insurance premium. So the line of credit is going to keep up with the growth of interest on the outstanding loan, the growth of interest and mortgage insurance premium. It's going to grow the same rate on the back end. Now I want to make sure you understand this line of credit with a growth factor. It is not it's not earning interest. I have many borrowers that say, I'm going to earn interest on that line of credit. No, let me make sure that you understand. If I go into my local bank and I want to apply for a credit card, let's say the local bank, Bank of the West in Denver, gives me a $5,000 credit line. And I'm very good with my new credit card. I'm paying regularly, I'm using it prudently, and at the end of year one, they send me a letter that says, congratulations, your line of credit is now $6,000. I did not earn interest. All that happened to me is I can borrow more money. My line of credit has grown, and that's exactly what this does. The second way is a monthly supplement to the borrower, a check monthly to the borrowers, or all at once as a lump sum, which would be the case in a purchase transaction, or if there's a very large existing mortgage that needs to be paid. Remember that this is a refinance transaction, and if there's an existing mortgage, we need to be able to take out that existing mortgage so that the new FHA loan is in first lien position. You can do any combination of the above, and I'm going to illustrate one of those examples for you. And here's the beautiful thing. If you start with your reverse mortgage one way, it's going to, you can change it at any time with a $20 fee, completely change the distribution options. And what else did the FHA do when they put this product together? They put in consumer safeguards. I'm going to run over them really quickly. Once again, this is a non-recourse loan. No deficiency judgment may ever be filed against the borrowers nor the borrower's estate. And that's a big deal to seniors. They don't mind taking the reverse mortgage, but they don't want to leave their kids in a jam. We know they retain title. We know they're entitled to the remaining equity. They can stay in the home forever. They're not required to make P&I payments, but there is the availability is there. There's mandatory counseling. Before a borrower can make application, they must be counseled by a HUD-approved counselor. These next two lines are very important, and I can't stress them enough. The growing equity line, the credit line, cannot be canceled, frozen, or reduced. We know that many of us, prior to 2007, had home equity lines on our properties. And when the financial crisis hit, the banks canceled those loans. They froze them, they canceled them, they reduced them because they had to have liquidity. The federal government required that they cover their risk. So in order to reduce the risk, they canceled all those loans. The other thing is that's very important is no matter what happens to the house value, the credit line, the equity line will continue to grow at the normal rate. So if the house declines and interest rates are climbing, what will happen to the line of credit? The line of credit will continue to grow at an even higher rate. So why are we even talking about this today? Because we've got some problems. We've got some problems, and the first one is we're living too long. Baby boomers are simply living a long time. 11% that one will live to age 100. So I have to tell you a funny story about Richard Russ. This is another Richard Russ story quickly. On his 83rd birthday, we were having a birthday party and he took me to the patio with a whiskey and water, because that's what we do in Wyoming. And he sat me down. He says, I have to tell you something. I was pretty concerned. I said, whoa, what is that? And he says, I'm 83. I can only live 2 more years because my financial planner only planned for my retirement to 85, so I have to figure out a way to die in the next 2 years. I laughed. Oh, my goodness. Anyway, so we're living too long. Problem number 1. Problem number 2, here's the wealth and how it's concentrated in these age groups. So the blue line indicates 100% of the net worth of a household. The green line is the cash. So without hitting exact numbers, you'll see that only about 25% of borrowers' net worth is in investments. The rest of it is in their home. So how are we going to get enough money for these borrowers to last through retirement without tapping their greatest asset? And the last problem we have is the transfer of risk that's happened since 1975. If you look at that blue line, that's defined benefit. Those are pensions. And we all know that pensions started to fade away and people had to open 401ks. You can see now that the transfer of risk is to the employee from the employer. And not very many people got on the bandwagon early on in this transition. So the people just did not save enough money. So let's solve the problems. Let's see how we might use a reverse mortgage to supplement income in 4 different scenarios. So here's the strategy. The line of credit with the growth factor, and you understand how that growth factor works. Supplemental monthly income is the second example. Number 3 is eliminating a monthly payment. And number 4, I'm going to show you how to do a HECM for purchase. And that is a great presentation for realtors. That's one that helps them with their business every day. So let's look at the line of credit example. We are going to take Joe Borrower, who is age 66. He needs $72,000 a year income. Here's his cash position, $750 in a 401k, $325,000 in cash. Here's his Social Security. So there may be a Mrs. involved here for $2,500 in Social Security. And here's the home value of $500,000. We're going to use that all the way through for consistency to make it easier to understand. Here's what happens with that line of credit. So at $500,000, we are going to take $5,770 in closing costs. That's all, $5,700, and put the balance into a line of credit. Now you say that line of credit looks like it's growing faster than a beginning rate. So the way FHA likes us to look at this, we use an expected rate when calculating the numbers. And let me tell you what that means. These are adjustable rate mortgages tied to the 1-month LIBOR. So the start rate today on a par rate is 3.15 with the LIBOR. We all know that 3.15 is not going to last for very long. At some point, we will have inflation and rates will go up. So they use an expected rate of what they believe this loan will do over the life. And what they think the average rate will be on this adjustable rate mortgage is 5.8%. So that's the growth rate you're seeing on this line of credit. So you see we start year 1 on a $500,000 home with $238,000 in that line of credit. I'm just showing you a 20-year ammo here. In 10 years, that line of credit based upon the expected rate of 5.8, $450,000. In 20 years, $913,000, almost $1 million. So where, and if I'm in front of you face to face now, which I usually am, I can look at a financial advisor and say to you, for $5,770, where can you get in 10 years $450,000 in borrowing power, in purchasing power, or almost $1 million in 20 years? And this is not tied to the value of the asset. So this is really a different product. Remember, it's tax-free. Remember, it's federally insured. So why would people want to have this line of credit? Well, what happens as people age? Things change. And one of the reasons we started teaching this class is a great reason to have this money available. What if you want to purchase long-term care insurance? What if you need home health care? What if there's home repairs that need to be done, or unexpected circumstances? And I can tell you that it always comes up. Either the kids or the grandkids need help. So let's move right along and talk about this line of credit. And here we're comparing this line of credit to a traditional home equity line of credit at a bank. So what are the differences between a traditional revolving home equity line of credit and a reverse revolving home equity line of credit? Because borrowers can pay back. They can use it just like a traditional line of credit. So both of the products allow the borrowers to tap their home equity, but only the HECM has no credit score requirements, no income, no monthly payments are required. The unused line of credit grows regardless of the value of the underlying asset. We're government insured, non-recourse, and it cannot be frozen, reduced, or canceled. The second, this is supplemental monthly income. Same borrower, 66 years old, same house, $500,000. He has the same Social Security, but he calls his financial advisor and he says, I need to take an additional $1,200 a month out of my investments, out of my 401k. And so let's look at what we can do here. If we give this borrower $1,200 a month, that's $14,400 a year. You can see that on the left-hand column. You can see the mortgage insurance premium that is accruing along with the interest rate. Now that rate, 5.8%, is the expected rate. The interest equals the new loan balance. But because he doesn't need all of the money available to him to make these supplemental monthly payments, the balance goes into the line of credit with a growth factor. So let me give you an example of how someone might use this type of product, this monthly product. I have a borrower who I've been working with. Her name's Kathleen, and she called. She's going to be 62 in May. She lost her job in the mortgage industry 2 years ago, and she's at the end of her unemployment insurance. So she and her husband were having an ongoing argument. She wanted, as soon as her unemployment insurance ran out, she was of the opinion that they should take that $1,000 a month or $900 a month out of their 401k. And they only had $60,000 in their 401k. Her husband's 65, she's not quite 62, and they were going to start pulling that money out of their 401k. Instead, their financial advisor says, talk to Colleen. So we did an example exactly like this, where they were pulling out $1,000 a month. Now what could happen? What's happening now is Kathleen does not have to file for early Social Security at 62. That was her other option. That's what her husband wanted to do. Rather than taking money out of the 401k, let's file for early Social Security. Well, Kathleen's full retirement age is 66. So if she takes her Social Security at 62, she's got a 35% permanent reduction in her Social Security benefits. So what she can do is take this money on a monthly payment, and then when she hits 66, she can stop the monthly payment and file for full retirement age Social Security benefits. Or what if she gets a job between now and then? What she can do in that situation is stop the monthly payment. So now no more monthly payments are coming out. If she's making enough money at this new job, she can repay the money that she withdrew earlier. So this is a wonderful tool. Let's talk about, there's been a lot of research done on adding this monthly payment from a HECM to retirement income. And our friends at Money Guide Pro have done the research, and here's what they came up with, and it's a very easy visual chart to look at. Without the HECM income, Joe borrower has a 58% chance of his money lasting long enough. When we add the HECM draw of $1,200, the probability of success of that money lasting throughout his retirement is 96%. That's how much it goes up. And this is just a waterfall slide. The blue shows without HECM income. The gold shows with HECM income. Having the ability to pull money from other buckets other than their retirement. Now let's look at paying off a monthly, an existing mortgage. And this is one of Steve's examples that we use in class. He had some customers who came to him recently and said, we need to start taking an additional $1,500 out of our 401k. So in his due diligence, Steve went through this borrower's entire situation and found out that they had an existing mortgage in place that they were making payments on, and roughly about $1,500 a month. So what could we do in that kind of a situation? Let's pay off the $100,000 loan. The closing costs are added to that. So we start with a loan balance. They had to pay higher mortgage insurance premium on this one because it was over half of what they could get. So $113,000 is the loan balance year one. The rest of the money goes into the line of credit. So you can see what happens. We've preserved their cash. And that's the change in the HECM from years ago to today. This is not a product of last resort. Don't wait until you're backed up against the wall. Get ahead of this thing and plan for that retirement income. So you can see that in 20 years, their interest has accrued, the loan balance has accrued to $300,000, but the line of credit is now $366,000. Are they better off for not taking that money out of their 401k? And the answer is, depends on how much money they have. So next, let's just talk about the last example I have, and then we're going to open this up for Q&A. Let's talk about HECM for purchase. And this is a really important product. I'm working with a pastor currently. I have Pastor Bob, he and his wife Pat are currently living in New Mexico. They called me day before yesterday. They are going to sell their beautiful home in a small rural town in New Mexico. They think they're going to get $125,000, give or take, for a purchase price. They're going to move to Denver into a wonderful 55-plus housing community. Minimum price, $250,000. And so what can they do? Their income, their retirement income, is not enough for them to be able to get a loan on this property for the difference. So we're going to look for them at a reverse for purchase. I'm going to illustrate that for you now, two different ways using our $500,000 example. And I'm going to use my pointer. I hope you can all see the pointer. We're going to use a downsizing example for Joe borrower. He has a departure residence worth $500,000. He's got some costs of sale. We've got commissions and fees and all of the things that go into that. Joe borrower is going to net about $460,000. He wants to purchase a home for $350,000. So what happens is he pays cash. Historically, he pays cash, $350,000, and takes the additional $110 that's left over, funds remaining, and gives it to you, his financial advisor, for prudent investment. Let's look at what he can do if we do a reverse purchase loan. $500,000 is the departure. He's still going to net $460,000. The new home price is $350,000. We're going to give him, because of his age, $190,000 proceeds from the reverse mortgage, which means that Joe borrower only needs to come to the closing table with $160,000. So here's what happens. He takes the difference, the $300,000, and gives it to you for prudent investment. How much longer can we make $300 last than $110? Let's look at an upsizing example because it works both ways. This man, Mr. Borrower, has a $500,000 home. He's still going to net $460,000, but now he's going to buy the Mrs. her dream home. It's going to be in a 55-plus housing community. It is all on one level with granite countertops. Washer and dryer are on the main floor. There's a bridge club. There's a golf club. There's a fitness club. This is a fabulous place. This is her dream home, and he wants to give it to her. So the cost of that is $600,000. What happens? He comes to the financial advisor. He comes to you and says, I need $140,000 out of my investment to buy my wife the house of her dreams. Let's look at a reverse for purchase upsizing. He's still going to net $460,000. He's purchasing at $600,000, but according to the FHA calculations based upon his date of birth, we're going to give him $340,000. So he comes to closing with $260,000, giving back to you $200,000 for investment. So we've bettered his position in this property by $340,000. So let's just sort of start wrapping this up so we can take some questions. Michael Kitces is one of the economists who's done a lot of work for us and is a great guy. The bottom line is fairly straightforward. Reverse mortgages may work far better when they're done not as a last resort, but as part of an ongoing retirement plan. Let's review the strategies one more time. Line of credit with a growth factor. That is the most powerful thing I have. Even if people don't need extra income, don't need to pay off a forward mortgage, don't have a crisis that's pending, where can they get in 20 years available money like they can with this HECM with a growth factor? Supplemental income, we know how that works. We can belay a borrower having to take early Social Security. There are a number of reasons that borrowers may want to take this money. We can eliminate their monthly payment, or we can do a purchase. We've gone over those. So let's just talk about these. These come from Steve's analysis over the year of how this really benefits not only the consumer, but the financial advisor. So we know that FHA has built-in safeguards to protect the housing asset. We know that draws from housing wealth can protect the investment portfolio. The HECM line of credit offers benefits that the HELOCs do not, and that is non-qualifying, non-cancelable, can't be reduced, and is not tied to the value of the underlying asset. The HECM HELOC also ensures access to housing wealth for the future. That's the line of credit. That gives you money in the years to come. And when I'm working with 62 and 65-year-old borrowers, they're so concerned about where they are today and the struggles that they're experiencing today that they're not even looking to the struggles and experiences they're going to have when they're in their 80s and in their 90s. So this is really important. This will enhance their wealth in their estate, and of course, you get greater withdrawal rates that are possible. I want to give you this funding longevity website. Security One Lending has launched this website especially for financial advisors. So jot this down. If you go to this website, you can calculate ways that you can use this mortgage. It's a wonderful tool. You can always pick up the phone and call me. You can call one of your other Security One Lending advisors, but you can start to play with this on your own at fundinglongevity.com. And thanks to the resources, these are the great gentlemen who took the reverse mortgage when it was not at all popular and started to study it and say, wait a minute, maybe we're wrong. These men have been absolutely instrumental in my being able to bring you this presentation today. And now, here's my contact information. You can email me, call me, and at the beginning of this slide you saw Steve's contact information. He is more than willing to discuss any ideas you might have, or if you have concerns, please feel free to call him or email him. For calling me, emailing me, if you think that when you get out of this webinar that this might be something that your entire office will be interested in, please let me know that. I'd be happy to help. Brandon, I'm finished. You want to turn it over to you for questions?
Thank you very much, Colleen. We already do have a number of questions in the queue. I'd like to remind all of our participants that if you'd like to ask a question, simply type the question in the question box on the right side of your screen. We have two questions that are somewhat related. One of them says, this is a great webinar. Thank you very much, sir. Will it be recorded to review again? And then the other question is regarding getting a copy of the slides. And so I'll answer both of those questions, which is that this webinar is going to be archived along with the slides at www.naifa.org/webinars. And normally we post our webinars, our recorded webinars and PowerPoint slides 24 hours after the presentation is over. The next question is, what if the primary residence is a duplex lived in by the owner and the other half is rented out to others? How would this work?
Perfect question. Thank you very much. Whoever asked it, thank you. FHA allows loans on 1 to 4 family residential properties. So long as our borrower lives in one of the units, the other units may be rented. So you can do a duplex, a triplex. I have a builder that I'm working with who is very interested in helping seniors really extend their money. So here's his plan, just to throw it out for your consideration. He builds a 4-plex. The borrowers are seniors. They do a reverse mortgage purchase. They are going to live in one of the units. They will have the other 3 units as income. Does that answer, Brendan?
Perfect. Thank you. All right. The next question is the accruing interest deductible?
The accruing interest is deductible if it's paid. Now, that is a strategy that is going to be, we're going to go in deeper when we do this advanced. We're going to do this again and do some more examples, and this is going to be one of them. Because if the borrower repays the loan, those payments go into the line of credit. So as they make those payments, that line of credit gets larger simply by the payments being made, but also then gets the growth rate. So it's a double bang for your buck. So think about that revolving line of credit or that loan balance simply as that. If you make payments, that interest is deductible in the year that the payments are made. If you make no payments, which is perfectly acceptable, all of the interest then is paid at the end if the borrowers are either deceased or sell the home. What that can do is help with taxes on the estate. So the answer is you can make payments, and if you make payments, they are deductible. If not, the payments are accruing, and all are deductible at the end.
The next question, is the interest that is accruing fixed?
Currently, we can do a fixed rate mortgage. The fixed rate mortgage is a closed-ended financial product, and this is currently. I think there will be changes coming to this in the near future, but currently, if a borrower wants to do a fixed rate, they must take all of the money that is available to them in a lump sum. And as you can see, there are a couple of examples where someone would want to do that. In a purchase, you may want to do that because you're going to take all of the money anyway. Or if we're paying off a large balance on a loan, then you would be taking that money anyway. If you want to use the line of credit with the growth, the monthly payments, or even just paying off that existing mortgage that was lower than the full loan amount, then the best product is an ARM, an adjustable rate mortgage, which is tied to the 1-month LIBOR.
The next question, would it make more sense to do this, meaning the reverse mortgage, earlier or later?
That depends. But let me give you an example. I am going to go back in my screens, if I can, here. Let's go back. Brendan, can you see my screen where I am right there?
Just fine.
Okay. Let's go back and look at this line of credit to answer that question. So if I do a reverse mortgage for this customer today, we are going to start that line of credit with $238,000. In 10 years, it's going to be worth $450,000, give or take, and nearly $1 million in 20 years. If that person waits for 20 years, when they're really in a jam, when their backs are up against the wall, go clear to the bottom, down to year 20, and what would they get in this year? $238,387 if they wait to do a reverse mortgage later. And that is assuming that the federal government will allow this program to continue for 20 years. So you always have to be careful about saying, I'm going to wait and do this in 5 years. Number one, you're going to have less money available to you in 5 years. And number two, we're not certain that FHA will support this product into infinity. We don't know that. So the answer is, yeah, it's good to look at it now. Learn about it now, look at it now. If it's not for you, that's fine, but there certainly are benefits to getting ahead of the curve.
I am age 65. My new husband is 35. Can I do this?
Congratulations. I love a woman that can marry a man 30 years younger than she. That is changing. I think, let me answer that with the best information I have now. Currently, we cannot do non-borrowing spouses. We want both spouses to be on the mortgage, because if the younger man is not on the mortgage, if his wife passes away before he does not have rights to stay in that property with a reverse mortgage if he's not 62 and on the mortgage. Now we anticipate some changes that will be coming whereby the loan amount will be reduced, where we can take a younger borrower than 62 and put them on the mortgage, but there will be a coinciding reduction in loan to value because of that young age. Does that answer the question?
Yes, thank you. The next question, for many of us, we have a broker-dealer. What is the general tolerance of this in the BD's eyes?
Well, I think, this is one of those questions that I'm going to say I would have to defer that. I'm going to have to get some answers. I certainly know I know a lot about reverse mortgages. I know them inside and out fairly well. What the broker-dealer's positions are, I would not dare to comment.
The next question, if a couple is 77 and 66, who is considered the primary borrower for the percentage of the loan?
The youngest borrower's date of birth is always the date that we use for calculating loan-to-value on a reverse mortgage. So it would be the 66-year-old.
And next, 5.8% is the illustrated rate. Does the rate get reset each year, and what impact does that have?
The adjustable rate mortgage is calculated monthly. So it is possible that the rate could reset every month. However, if you Google the historical LIBOR index, you'll see that there's been very little fluctuation in the LIBOR over the past 7 or 8 years. So the answer to the question is, it can reset monthly. But unless the LIBOR goes up or down significantly, you're not going to see much change in the interest that's accruing. But let's say we've been in a period of deflation for a long time. Let's say now we're getting ready in a year or two, I don't know the answer to this, but we start to experience inflation. What will happen is the LIBOR will go up, so the accruing interest will go up. But if the accruing interest is going up, so is the growth factor on the unused funds. So there's still a benefit to having the loan even if rates start to rise.
Next, I live in an area where nice homes average about $250,000, not $500,000 as used in your example. Would that mean most values in your presentation would be about 50%, assuming all else is the same, perhaps a $600 monthly income, etc.?
It would be very similar, and I would tell you to know exactly we should run a quote. I can run a quote for you. You can go on to Funding Longevity and get some answers there. Either way, whichever's better.
Next, thank you so much for this important information. If a person goes to buy a second house and lives less than half the time in the original house, is this still okay for a reverse mortgage?
The laws governing how long you can live, how much time per year you can live in your primary residence are that's the IRS. That's an IRS regulation that you need to live in your primary residence 6 months plus 1 day. So those are not fixed by FHA. Those are set by the IRS, the amount of time that you must live in your primary residence in order to for it to qualify to be a primary.
All right, fasten your seatbelts. We have about 3 more questions and 2 more minutes. We'll try to get to them all. Can the line amount be increased as the borrower ages, or is the amount locked in for the duration?
Once the loan is closed, the amount that starts that line of credit is fixed. And unless that borrower refinances the whole loan, and there's generally not a lot of reason to do that, we would not change the amount that's in. We wouldn't arbitrarily change the amount that's in the line of credit. We couldn't do that. But as interest rates rise, the line of credit growth factor will rise. There is no resetting during the term of the loan. Does that answer, Brendan?
Yes.
You have to answer for everyone. I'm sorry.
Well, your answers are clear and concise, so it's an easy job. Thanks, Colleen. If you have to move into an assisted living because of health, is there any money from the HECM that can be used to fund the assisted living?
That's a sticky wicket. Let's look at a couple of different scenarios. Let's say there are 2 borrowers and one goes into assisted living. The other borrower is living in the property, so the reverse mortgage goes on exactly as the original terms specify. What happens if it's the remaining borrower or a single borrower and they have to go into assisted living? And here's where I have to turn and ask a question back. Is that borrower in assisted living because they had a hip replaced and they're in rehab, or knee replacements or heart surgery, something? Are they coming back to the home as their primary residence? If the answer is yes, then it's still their primary residence and the reverse mortgage is still in place. If the answer is no, if we have taken care of a loved one with dementia for years and it's just finally too much for the family to handle, and we put this loved one into assisted living, then are they coming back? If they're not coming back to the house as their primary residence, you might as well stop the accrual of interest and mortgage insurance and get that house on the market and sell it if the borrower's not coming back.
Okay, we have time for one last question, I'm afraid. What if I want to move after getting the reverse mortgage?
It's exactly the same as if you have a traditional forward mortgage. So what happens is you say, you know, I really want to move to the beach. I'm tired of this retirement community. I want to get out of here. I'm moving to the beach and going to live a completely different lifestyle. So they decide to sell the home. If the balance on the reverse mortgage is less than the value of the home, the borrower simply puts the house on the market, sells it, and pays off the underlying reverse mortgage, taking the remaining equity to move forward with them. If there is not remaining equity in the home, the borrower can simply call the lender and say, thank you so much, it's been wonderful having this reverse mortgage, and they can move out of the house with no liability for the deficiency. Then we will remarket the property and go to the FHA mortgage insurance premium pool if there is a deficiency. If there's no deficiency, the borrower is entitled to 100% of the remaining equity in the property.
Thank you. We're going to sneak one more question. And while I'm doing this, Colleen, if you would please show the slide again with your contact information, because I know some others out there may have some additional questions. And we're going to field this very last question. Since the title remains with the owner, what happens to the home after both parties to the loan are deceased?
Then the estate comes in and takes a look at the value of the property versus the loan balance on the property. And once again, if there is equity remaining, they put the house on the market, sell it, and split the equity according to the terms of the estate of the will or the trust. If there is not remaining equity in the property, then the lender can take the property back and remarket that property. The estate can settle without settling or selling the property because there will be no ramifications of any deficiency judgment to the estate.
Excellent. We've gone just a few minutes over, so I appreciate the patience of all of our participants and letting us get all of their questions answered. And thank you so much, Colleen, for working overtime for us today to answer the questions. I want to thank all those who participated in today's program and remind you that to access today's presentation and other webinar archived resources, please go to www.naifa.org/webinars. This is Brendan Burnett for NAIFA.